Moving on to gold now. The yellow metal up more than 9% from its 2018 lows. Our next guest, the man who created gold ETFs, says the conditions are right for it to move even higher this year. Jan van Eck Associates, an old friend of mine, joins us now. Jan, your firm is behind the two main gold equity ETFs. That's the gold miners and the junior gold miners. Can you describe for us, this is an educational program, the difference between investing in gold, the commodity, using an ETF, and investing in gold miners using an ETF?
Sure, Bob. Great to be on the show. I think, first of all, gold shares are almost like a leveraged play on gold bullion. So, and they have an equity component. So the theory is if gold bullion goes up 1%, the shares should go up maybe 2%. But they also have exposure to the stock market. So if the S&P goes down, there's likely to be a drag on GDX and GDXJ.
Yeah, that's a problem, guys. I think Jan mentioned the essential issue. You've got exposure not just to commodity when you own the gold mining stocks, but the stock market. We saw this in December. Jan knows this. Gold stocks went through the floor on the chaos, and gold went up. So you actually had
think about what's been going on.
Related assets moving in two different directions.
And by the way, Jan, I'm sorry that we have to be on TV to hang out. I mean, I've known Jan almost as long as you have, Bob. So great to talk to Jan, who really does know what he's doing in this space. And I would just say, whether you're investing in miners in any underlying commodity, the bottom line here is, as we've seen over the last decade, is how companies allocate capital, how efficient they are with their balance sheet, whether they are growing at all costs rather than truly investing on behalf of their shareholder base is critical. It's why miners underperform.
So, Jan, how do we deal with this issue?
I got to flag something here. I got to flag something because the shares have been acting tremendously well over the last 2 or 3 months. So in Q4, the gold GDX was actually up about 14%. So it's starting to zig when the stock market zags. When I left the office a couple of minutes ago, U.S. equities were down, GDX was up. The same is true yesterday. In fact, in the majority of the days in Q4, when the S&P was down, GDX was up. So that zigzag, that decoupling, makes me really excited about gold shares as a diversifier.
Right. Assuming, I want to, again, let's take it from the point of view of somebody, I want some exposure to gold. Can you make an argument that owning gold equity ETF is a better opportunity to get exposure than just owning GLD, which is a pure play on gold itself? Can you make, is there a rational argument to make about that?
I would say today, Tim's point, I think it was Tim's point about the gold mining companies being very well run, being cost conscious, so that's important. You want that kind of discipline. And what you're seeing technically in the behavior is the shares should outperform given that cost discipline. And they're moving separately from the stock market, which is really that zigzag. That difference is what I like to see as an investor looking for diversification.
And Jan, let's talk about the underlying metal, because I agree with everything you're saying on the outperformance of the companies to the spot. You could make an argument that gold, during a perfect witch's brew of global dynamics and is supposed to be defensive, really underperformed for the 2 years from Brexit all the way through this period we're talking about in December, where it's finally outperforming. How do you explain that? And because people that own gold ultimately have owned it to be this hedge during chaotic times.
Yeah, I mean, I focus on number one thing, which is central bank liquidity. Is the Fed and cohorts pumping money into the economy or pulling it back? And, you know, it's no surprise to me that in mid-December, when you started to see equities melt down, was literally the week where the European Central Bank stopped buying bonds every morning. They stopped buying bonds, period. So that pulling back of liquidity, to me, is the stress on stocks and bonds. If they can't get that tightening done, that's great for gold, because people will lose confidence in the central bank. And so I think the last 2 years are not, you know, I think, anyway, I think there's good case for a hedge right now.
Let me just pivot a little bit and ask you about Bitcoin ETF. You're one of the people that has a Bitcoin ETF application out with the SEC. You told us this morning you're going to be withdrawing that application. It was up for a thumbs up or thumbs down within the next month. Can you tell us why you withdrew the application?
Yeah, so technically, well, you know, the SEC is affected by the shutdown. So we were engaged in discussions with the SEC about the Bitcoin-related issues, custody, market manipulation, prices, and that had to stop. And so instead of trying to slip through or something, we just had the application pulled, and we will refile and re-engage in the discussions when the SEC gets going again.
But let me go ahead.
Well, I just wanted to add one comment. I do think that Bitcoin pulled a little bit of demand away from gold last year in 2017. Interestingly, we just pulled 4,000 Bitcoin investors, and their number one investment for 2019 is actually gold. So, gold lost to Bitcoin, and now, it's going the other way.
But I want to clarify about why you pulled the application. You're not saying you pulled the application because SEC is closed necessarily. I mean, they were very concerned and have expressed their concerns about the inability to solve the custody problem, as well as the fact that most Bitcoin's priced overseas where they don't control it. Those are still major issues. I think you faced the prospect they would have turned you down anyhow, don't you think?
Yes, absolutely. But we think we actually have pretty solid answers to those, but we just need to really demonstrate it very, very clearly and convincingly to the regulators, and we were trying to do that, but we obviously can't have meetings while they're shut down.
All right, just quick comments from...
I think additional headwinds, just for the under the hood portion of the show. Going back to the golds, the GDX and the GDXJ are so successful because they mitigate single stock risk. So if you're going to try to pick one of those stocks and realize the risk, that is why a lot of retail clients flow to these ETFs. With the Bitcoin, an additional headwind, let's say it gets through all those things, how are market makers going to price the hedge or price the create redeem basket when they don't know what the price is based on? And even if you say it's going to be based on futures, well, what are you basing the futures on?
Well, look, ETFs are supposed to bring both a thematic expression and some sense of confidence in that I'm actually very well hedged and I'm owning an asset class or expressing something specific. But that's really the fundamental issue right now with cryptocurrencies, because not only have we lost all liquidity in the underlying, but truly outside of the existential blockchain argument, it's been very difficult to argue store of value, which is really what we started hearing about. Gold is a store of value, and there's no disputing that. And the cyclicality in the gold price, and I agree with Jan, there's no question that Bitcoin sucked life out of essentially the gold market, and it is a crossover, pitchforks and shovels, kind of a crew that really are rabid in both cases.
All right.